Well, I thought I'm a little bit surprised to be here today because apart from a few directorships, I've been out of active business for some 8 years now. However, when Prem Watsa calls, you know, the Warren Buffett of the North, what do you say? You've got to say yes. But the main reason I'm delighted to be here is that I firmly believe in the basic mission of the Ben Graham Center at the Ivey School, to encourage both corporate management and investors to focus on long-term shareholder value creation. As markets have evolved, there has developed, in my view, an unhealthy short-term orientation, which is totally counterproductive. The amount of trading today by institutional and retail investors with attendance tax and friction costs is off the charts. No company grows in a straight line, but unfortunately, most investors just do not have the patience to stick with great companies through the ups and downs to realize truly outstanding long-term investment returns. Investors should think more like owners and management of a business who invest for really long term, as opposed to opportunistic in and out traders who really have no interest in the business at hand. I have learned that you can't time the market, and you are best advised to find a few companies and a few management teams and great chief executives and a business that you like and take a major interest in it on a long-term basis. A concentrated portfolio is the answer. Now, my subject today is creating shareholder value, slow and steady wins. It was Eddie Cantor who said, it takes 20 years to make an overnight success. And I think that concept is valid in many businesses. And there are lots and lots of examples. Building a business and creating lasting shareholder value is a marathon, not a 100-yard dash. And success, in my view, is measured in decades of performance, not by quarterly or annual results. I am always wary of companies that grow too quickly. And over the years, there have been many high-profile flameouts, some large and some small. Dome Petroleum, Nortel, and Valiant come to mind, each of which grew quickly to become the most valuable company in Canada by market cap before encountering major problems. The big money, in my view, is made by focusing, investing, and having a commitment to a long-term strategy over 1 or 2 decades or maybe longer. Now, today I will try and convey to you some of the business lessons my partners and I learned over the years at Dominion Securities and successor companies as we grew the business through mergers and organically from 1973 to the late 1990s. I should say at the outset that since I stepped down as CEO of RBC DS in 1998 and as chairman of RBC Capital Markets in 2007, the business has grown far larger, far more global, and profits have grown to a level that I could never have imagined. And there were a number of important lessons we learned, management and investment lessons, which are hard to teach in business school. The first lesson was how far you can reduce corporate expenses in your company if you really want to, without cutting into the muscle of the firm or reducing its capability. DS and Harrison Partners merged in 1973 to form Dominion Securities Harris. DS was losing money and some market share, so it was a merger of some necessity. And business was brutal until 1980, as you can see from the sheets that I have circulated at your tables. The combined firm had starting shareholders' equity of $13.3 million, a minuscule amount in today's terms. And with restructuring, we lost 10% of our capital in the first year, bringing our equity down to $12 million. We were a private company, and many partners were underwater on their bank loans. We reduced our staff count from 870 to 580, significantly reduced salaries, closed some branches, and implemented incredibly strict expense controls. Our overhead structure was reduced by more than 1/3. While we lost $2 million in our first fiscal year, which was 1974, we made $3 million in 1975 on reduced revenues and have been profitable every year since, over 40 years. During this time, we learned that everything in business is a necessity until it isn't. It's amazing what you can do without. Secondly, in the 1970s, we learned the importance of having a business model and overhead cost structure which enabled us to earn single-digit returns on equity during prolonged periods of low activity in capital markets, but much higher returns in buoyant markets. Bear in mind, if you are the lowest cost producer or even in the lowest quartile in your industry, it gives you a huge competitive profitability edge. Most businesses do not get serious about cutting costs and improving productivity until they are forced to by a recession or some external shock, such as we experienced in 2008. Expense control is not a one-time event. Rather, in the company, you must develop a culture of continuous cost containment drilled into the DNA of the company. Most companies, especially larger ones, do not do a good job of controlling expenses and suffer from what I call bureaucratic creep and become somewhat bloated in the good times. Great companies focus on costs and productivity even when profits are high and rising. They set the bar high. Many years ago, Harrison McCain was giving me a tour of the McCain French fry plant in the head office down in Florenceville, New Brunswick. We finished the tour and we're walking through the office portion of the building, and I said, "Harrison, you've got some holes in your carpets here." Harris turned to me and said, "Tony, carpets don't make money." Wallace and Harrison McCain knew a thing or two about controlling expenses and focusing on productivity, just like Hunter Harrison at CNR and CP. We need more of that type of corporate management. Third, we learned in business that patience is a virtue. After a year or two, we deemed our first merger in 1973 a success. We also knew that the large U.S. investment banks were coming to Canada, and there had to be consolidation in our industry here. We put the word out to several firms that we are amenable to a combination to our mutual benefit. But these firms were partnerships with strong personalities, and it turned out to be a long-term waiting game, which was very frustrating at the time, but at the end of the day, well worth the wait. In 1981, we acquired A.E. Ames & Company, which had a wonderful and colorful history dating back to 1898 and had a great national franchise. Excuse me. Ames had been mismanaged at the top and suffered during the 1970s. And when we completed the audit for the deal in 1981, there was no equity left in the business, and we got the whole franchise for nothing. We changed the name from D.S. Harris to D.S. Ames. A few years later, in 1984, we were able to combine with Pitfield Mackay Ross, another strong national franchise with excellent people and great pipeline, telco, and utility accounts. We had approached Pitfield 10 years earlier and kept in touch, but the timing was never right. But all of a sudden, it was. We changed the name from D.S. Ames to D.S. Pitfield. In 1991, we were able to acquire Pemberton Securities in Vancouver, which had an exceptionally strong franchise and account base in Western Canada. We paid $110 million in cash. We had made several approaches to Pemberton over the years, which were turned down, but circumstances finally changed. In 1996, we concluded the acquisition of Richardson Greenshields with head office in Winnipeg for $480 million. Richardson had many top people and a strong national distribution network. Again, we had been calling on George Richardson for many years without success, but their family circumstances changed and the timing was right. In addition to these larger deals, we also acquired a number of smaller niche and boutique firms as they became available, including Molson Rousseau and McNeil Mantha in Quebec. Now, in 1991, we were fortunate to be able to enter the real estate business with the acquisition of Marcel Trust. Marcel had built a strong national real estate franchise and had some absolutely outstanding real estate professionals, including, of course, Doug McGregor, who is now chairman and chief executive of RBC Capital Markets and has been for the past 9 years, and doing, I should say, an incredible job. When I look back, every firm that we merged with or acquired had some better people, and they had some better systems and technology than we did. We were always fair, but exceptionally diligent in keeping the best people and systems from each firm. Fourth, in the 1970s and 80s, we learned there was a trade-off between profitability and market share. And in our experience, return on capital and return on equity wins hands down. We always said we are not in business to trade dollars or earn a marginal return, but to make money and plenty of it. Return on capital is what business is all about. Far better to work for or invest in a smaller but highly profitable firm than a larger marginal one. Market share is nice, but profits and a high return on capital are better. For example, in the early 1980s, we substantially downsized the size of our retail sales force across the country and closed several marginal branches. Our market share went down, but our profitability in that division improved dramatically, giving us more money to reinvest in the franchise. Fifth, we learned over the years that if you don't have the best and most capable people, you are dead in the water. In any business, it's far better to have one top-flight professional than 2 or 3 marginals. We always tried to run our firm with fewer but more capable people. One of the most important profitability metrics we used was revenue per staff count. We learned we had to approximately double our revenue per staff count every 10 years to meet our return targets. At the same time, we learned that it's incredibly important to relentlessly weed out non-performers in your company. I think most companies do not do a particularly good job of this. Always remember that a firm operates as a team, not as a family. In a family, you put up with wayward members, but in a team, you have to try out every year, and either you make the cut or you don't. It was Jack Welch at GE in a speech to senior executives who said, "Shame on any of you who aren't facing up to poor performers. Move them out early," he instructed. In my experience, nothing worse than an organization where middle and top management are clogged up with marginal people who have been promoted as far as they are going to go and are now just putting in time and blocking the way of more capable and aggressive younger people. Another lesson we learned is that you should set the bar high in terms of your results, in terms of profitability. Set aggressive targets, because nobody rises to low expectations. Apart from growing our firm over this period, there were 2 other initiatives which have had a major long-term impact on our business. First, in the 1980s, the global financial industry was becoming more competitive and capital-intensive. In the U.S., apart from Goldman Sachs, all of the major dealers were public companies with access to markets. In response, we took DS public in 1986, selling 20% for $110 million, substantially increasing our shareholders' equity to $204 million. The IPO was priced at 2.1 times book. The issue was a good success financially, but we did not like being a public company. We didn't like the focus on quarterly results, we didn't like the analysts, and we didn't like the press. Besides, being a public company encourages short-term thinking due to the constant pressure from analysts and short-term in-and-out investors. Second, the global regulatory environment was changing rapidly. On October 27, 1986, Margaret Thatcher implemented Big Bang deregulation in London. And there were early signs at that time that Glass-Steagall might at some point be repealed. In response to all of this, in 1987, the Canadian Minister of Finance, Michael Wilson, who as a matter of interest was a senior partner of our firm for many years, introduced changes to the Bank Act, permitting Canadian banks to enter the securities business and foreign investment firms to buy a Canadian dealer. We were very reluctant to sell control because we placed a high value on our independence. Nevertheless, with other firms, Nesbitt, McLeod, and Wood Gundy selling out and the U.S. firms coming to Canada, the writing, I think, was on the wall. We were initially approached by Scotia, BMO, and then by the Commerce. But they all wanted to buy 100%, and they all wanted relatively rapid integration. We were not interested. Also, we had very attractive offers from Morgan Stanley and Merrill Lynch, but we wanted to remain Canadian. We had built our firm here in Canada, and we felt it was important to our future business to maintain a strong Canadian identity with no foreign shareholder controlling our business. When I look back on what has happened to these two U.S. firms in the financial crisis at that time, this was one of our best long-term decisions. We had kept the lines of communication open with the Royal Bank and entered into serious discussions with them over the summer of 1987 and concluded a deal in late October, with the transaction closing March 31st, 1988, and the name was changed to RBC Capital Markets. RBC Dominion Securities. Under the terms of the arrangement, the bank acquired about 75% of the outstanding shares of DS and paid 1/3 in cash and 2/3 by way of Royal Bank common shares. They bought all the shares held by the public and 2/3 of the shares held by our partners, leaving us with a 25% ownership. The transaction valued the firm at $512 million. We were very happy to be a private company once again. We decided to go with the Royal Bank not because they were the largest, but because the chemistry was right and we liked the people involved. We liked the reputation and credit rating of the bank and the power of their retail franchise. Of major importance, notwithstanding their majority control, our ongoing 25% interest ensured a high degree of independence and segmented accounting, which was important to us so that we could measure our own results. We were initially concerned about being overrun by bank bureaucracy, but it didn't happen. While there was the odd speed bump, the bank was very, very supportive of our initiatives. After the deal closed in March 1988, we cooperated with the bank in many small ways, but they were in Royal Bank Plaza and we occupied Commerce Court South and Commerce Court East, where we stayed for another 8 years, basically running our own business. Integration of RBC, DS, and Royal Bank was a deliberately slow process over a decade, and the bank finally acquired the remaining 25% in 1998. We were disappointed to give up our majority interest, but RBC DS, quite frankly, had become so integrated and dependent on the bank's balance sheet and the bank's credit rating, it was just the right thing to do. 10 years after the initial deal, integration of DS into Royal Bank was complete, and the name was changed to RBC Capital Markets in 2002. The RBC DS deal is now 29 years old, and as it has evolved over almost 3 decades, the synergies and shareholder value creation on both sides have been far beyond, I think, what any of us could ever have imagined. The power of the Royal Bank franchise was an incredible accelerant to our business in the securities side. We were gratified that over time a number of DS people assumed important responsibilities at the bank, including Gord Nixon, who joined DS in 1979 and ultimately became chief executive of RBC for 13 years. And now, 2 of the bank's largest businesses, capital markets and wealth management, are led by DS alumni. In terms of creating long-term shareholder value, when the RBC DS deal closed in 1988, Royal Bank stock was trading at $3.58 a share on the present stock, and the dividend yield at that time was 7.3%. In the 29 years since then, RBC shares have increased by about 2,600% at a compound annual growth rate of 12%, plus an average dividend yield of about 4.5% for a 29-year annual return of maybe 16.5%. Over the period, RBC increased its dividend 37 times. In the 43 years since the DS merger in 1973, the average return on equity in the business was about 20%. I've now been gone 8 years from the business, and it's hard for me to believe that last year RBC Capital Markets earned net income after tax of $2.3 billion, of which $1 billion was in the United States. In looking back over the record of DS and successor companies, my partners and I have found that, yes, indeed, slow and steady, building a business, you might say brick by brick over many years, may not be glamorous, but it does pay off. Now, apart from DS, I have learned some other important lessons during my years in business. I have learned that you can't forecast a crisis. They always seem to come at you out of left field. I have experienced what I regard as 6 major financial, real estate, commodity, or banking crises, none of which were generally forecast by economists or market pundits. What's the lesson? The lesson is be prepared. If you believe we have seen the last major crisis, just be patient. One is coming. We just don't know when. When I was with the bank, I always said we should have as many economists on staff as possible to increase our chances of having one that's right. And I learned from experience that central bank governors, ministers of finance, and treasury secretaries know no more about what the future holds than you or I. Make sure all your people check their egos at the door when they come to work. Big egos and flamboyant CEOs have gotten a lot of companies into major trouble over the years. I prefer low-profile CEOs who shun analysts and focus all their energy on executing their strategy and running their business. Corporate management and investors should always insist on ultra-conservative accounting because I have found, sooner or later, aggressive accounting always catches up with you. And focus on companies which are earning or have the potential to earn a high return on capital and which are generating or have the potential to generate substantial free cash flow after normal CapEx. Be cautious and skeptical when expanding through acquisitions for reasons listed on the sheets I have distributed at your tables. Always remember, often the best deals you do are the ones you don't do. Another lesson, it's easy to have a grand strategy and corporate vision. But always remember, vision without great execution is hallucination. And we've seen lots of hallucination over the years. It was Churchill who once said, however beautiful the strategy, you should occasionally look back at the actual results. Finally, let me say that the most important lesson I have learned over the years, and I think it's common to all businesses, is that your number one priority is to look after your customers. And always, always make sure you are placing the interests of your clients first. If you treat your customer with respect, with integrity, and with high ethical standards, you will be rewarded with loyalty and will build a solid reputation for doing what is right for your client. In my time, I have seen far more financial firms get into major trouble and in many cases go out of business altogether due to greed, corruption, and regulatory problems than from all the competition combined. But it's not just the financial business. Think Volkswagen and the emissions scandal, Valiant and the new accounts, Wells Fargo and the new accounts, Arthur Andersen, Enron, and WorldCom, and there are dozens more. In any business, there are lots of practices that are legal, but that are also totally and completely unethical. And that's where I think many firms go astray. They come to think if it's legal, it's okay. But that's not the question. That's not the test. The question is it ethical? Are you really placing the interests of your clients first? You can legislate and enforce the law, but you can't legislate high ethical standards. You either have them or you don't. In any business, your reputation for ethics and integrity and for treating clients fairly is by far your most valuable asset. And if it is ever tainted or tarnished, it is almost very, very difficult to regain it. And people in business should never forget it. Now, fortunately, there are a number of Canadian companies and chief executives and management teams which take a very long view on building their business and have been highly successful over long periods of time, and I believe fit the mold of what I have been talking about, including, of course, Prem Watson and Fairfax Financial. But looking further afield, for example, Bruce Flatt at Brookfield Asset Management has been patiently acquiring incredible infrastructure, real estate, and other assets around the world over the past 10 years. And the payoff will come over the next 10 or 20 years. It's a terrific Canadian success story, and I think the best is yet to come. It just requires patience, long-term patience. Another would be Galen G. Weston, Chief Executive at George Weston and Loblaw, a family-controlled company which can afford to take the long-term view and implement a long-term strategy. Galen, now 44, has totally rebuilt Loblaw from the ground up over the past decade and has formulated a terrific health and wellness strategy around the Shoppers acquisition, all of which will pay off increasingly over the coming decade and longer. This is a company, and at 44, he's got a lot of runway ahead. Another name I would mention is George Cope, who became president and CEO of BCE in 2008. At the time, BCE Bell was slipping badly in market share, profitability was eroding, and the company's network had not kept pace, and the dividend had flatlined for 10 years. Since then, George has basically rebuilt and re-engineered the company with an entire new management team. Free cash flow has increased steadily, and the common share dividend has been increased 13 times. On George's watch, BC's stock has almost tripled from the low 20s to almost $60, all the while providing a strong and growing dividend. And then there's a smaller situation, Stephen Johnson, a Canadian Real Estate Investment Trust, CREIT. Stephen has been CEO of CREIT for over 20 years, has built a terrific, diversified real estate investment trust based on his strategy of quality, diversified real estate, low leverage, a low payout ratio, and ultra-conservative accounting. It's a great story. And I also mention CNQ, Murray Edwards, another great story over the last 20 years. And here again, you've got a really great management team, and I think the outlook over the next decade, you back people. And when you're investing, you back people, CEOs, management, and the board of directors. Also, in my view, in terms of creating long-term shareholder value, slow and steady wins, the Canadian banks are global superstars. You just have to have patience. Most people would not realize that the Canadian Bank Index is about the only subsector in North America to generate a better total return than Warren Buffett's Berkshire Hathaway over the past 20 to 25 years. And the Canadian banks are now far stronger than they were 10 years ago, with much lower leverage, much lower single-name exposures, a more diversified business, more regulation, all of which means lower risk. The big six Canadian banks earned an average return on equity last year of 15.4% and are selling at a modest multiple of 11.4 times, an average dividend yield of 4%, with dividends increasing 6 to 7% a year. It's a great story. For generations, Canadian banks have been wonderful vehicles to generate long-term shareholder value, and I believe that will be the case for years to come. Just as an aside, when I started business as an analyst in the early 60s, I was a bank analyst. But one of my responsibilities was to value the portfolios of some of the larger clients of the firm, including the Scottish Investment Trust based in Edinburgh. And this was in 1960. They owned large amounts of the Canadian banks, virtually all of the banks. And their cost was pennies per share, and they'd held them for 30 and 40 years. It was quite an amazing, it was really quite an eye-opener. And of course, if you I did a bank report in 1965, and I look back, it was terrific advice. There was some downtimes for sure, but if you stick with these banks, over the years, they seem to have an ability to generate good management, conservative management, and the record clearly shows, as I say, they're global superstars in terms of value creation. In closing, let me say that for those of you who would like to dig a little deeper into the long-term value of investing, there is a small book, The Outsiders by William Thorndike, which is absolutely indispensable reading. The book documents the record of 8 chief executives of major American companies, the shares of which outperformed the S&P 500 index by a factor of at least 20 over a period of a minimum of 20 years. Their CEOs were true long-term value managers, and it's amazing the similarities amongst the 8. This book is filled with business wisdom and highlights the importance to any company of the CEO and the value of taking the long-term view. I am sure many of you read the book, but for those who haven't, I have left some copies at the back, which you can take as you leave. It's a great read, and I reread it from time to time. So, ladies and gentlemen, thank you very much for your attention. I look forward to the rest of the conference over the balance of the day. And if there's time, be happy to take any questions, or we can do that later, George.
Actually, last year, Tony attended the conference. Actually, I saw him back there sitting. Actually, I saw him when he was leaving. I said, oh my God, I said, Tony Feld is here, and we must have him. He's an outstanding value creator. So I said, Prem, we've got to call Tony, and it happened. So I'm so glad. So Tony has agreed to take a few questions, but you are going to have an opportunity for more questions at the end. He's going to sit here on a panel with the CEOs at the end of the conference. So I have time for a couple of questions. So the mics, please. So over here, and then the other mic over there.
Hello, Tony. You've always liked in the past gold. I'm curious why, and what is its outlook in your view?
Outlook for gold bullion, a subject dear to my heart. I followed it closely in the 60s and early 70s because, you know, it looked like we were coming into a period of really rapid inflation and rising interest rates. And the gold price, as you know, performed incredibly well, rising from $35 in the early 70s to over $800 by 1979 or so. So that was a good time. Did I get out? No. I guess gold has taught me a lesson as I followed over the years. I liked it in the 90s. It was in a bear market, and it did well from 2000 to 2010 or so, but then it had a significant downturn. I don't think it's possible to forecast the price of gold. And I've given up trying to forecast it. I would not make a forecast on the gold price now. I do think that it's worthwhile having a gold exposure in your account, in your portfolio. Because I think in times of I think gold does hold its value over decades or over 100 years. It does hold its purchasing power. So I think it's a stabilizing factor in very difficult times. But how much you should have in gold, I'm not sure. Maybe it's 5%, certainly no more than 10%, because it doesn't pay any interest, it pays no income. It's just sort of a safety valve in case of the ultimate disaster. There's more leverage in the gold shares. I prefer the gold bullion because in the gold shares you've got the risk of the gold price, and then with the shares you've got the risk of bad management, potential bad management. So I believe I'd rather hold the actual gold bullion unlevered on a long-term basis as a safety hedge. But where it's going now, I wouldn't hesitate to make a comment. I just don't know. Sometimes it's better to tell the truth.
Hi, Tony. Victor Liu, right over here.
Yes.
I had a quick question. You mentioned sort of how successful the Canadian banks have been, both from a shareholder value perspective and just from a business perspective. I was wondering if you could sort of tell us a little bit more about why you think the Canadian banking sector has been so much more successful than its counterparts globally, especially the U.S. What is it in terms of either management or the regulatory environment that makes it better, both in the past and over the long term? Thank you.
Is that why the banks have done better here?
Just the Canadian banking sector, why has it been so good in the past? And why will it continue to be good in the future relative to markets like the U.S.?
Are you asking about Canadian? Are you asking? I'm sorry, I'm having trouble understanding the question.
There's an echo here, and it's very hard to hear from here.
Tony, so you had highlighted earlier how successful the Canadian banks have been.
Yep.
I was just wondering why that has been the case relative to, let's say, the United States.
Oh, okay. Yeah. I think it's inherently, The Canadian banks have been more successful than global banks in the US or in the UK, I think primarily due to more conservative management. Canadians inherently are more conservative than Americans, and that has shown up in spades in Canadian bank management if you look at the long-term record. But also contributing, our mortgage market in Canada has been far better controlled than it was in the United States. I think the regulatory process in Canada has been better. We had tougher rules on maximum leverage. So I think we've had better regulation for sure, and we've had more conservative management. I mean, when you look at what happened in the 2008 period, or the 5 years leading up to that, there was particularly in the UK, like the Royal Bank of Scotland, they got into such massive amount of trouble with their large acquisitions. They were trying to expand the bank with $100 billion acquisitions in the teeth of a developing storm. How they could ever go through with it, I just don't know. And the same with the American banks. The leverage ratios of the American banks and the American investment banks escalated dramatically in the 4 years leading up to 2008. The big investment banks, their leverage ratios were moving up towards 30, 40, and 50 to 1. It was just not healthy. It was very high risk. I don't think they thought it was high risk because they didn't see the downturn coming. But I think Americans generally are more aggressive in some ways than Canadians. That's another way of saying we're more conservative. I think the Canadian banks, I think it's amazing how they, as I said earlier, they seem to be able to generate good people, good management people. They have good succession planning and have had for a long time. Obviously, there have been some hiccups, but generally, the bar has been set pretty high. So I think it's more conservative management and better regulation that we've had, particularly in the mortgage market.
Okay, last question.
Good morning, Tony. Thank you very much for your speech. It's Wayne Peters from Sydney, Australia. That conservatism that you speak of, do you think that's reflected today in the Canadian property market, especially in Toronto and Vancouver? And if not, do you have concerns with the property prices here?
It's very hard to hear. We need to put another speaker here for the panel. Don't use the mic. Can you just...
That conservatism that you speak of, Canadians, do you think that is reflected in the property market?
With bank stocks in the property market?
Yeah.
The conservatism you talk about
Yeah.
in the banks, do you think that's reflected in the property market in Canada?
Well, as I understand the question is their exposure to residential real estate and property reflected in the current markets? I would say that is, yes, I believe it is. I think the banks are selling at very low multiples. Based on the record, based on the dividend growth and the prospects. As I said earlier, they're much stronger. The capital requirements of being in the banking business have increased by approximately 50% over the last 10 years. So the leverage ratios are much less. I can tell you firsthand, I'm not in the business right now, but from what I observe, the loan books, including the mortgage books, are far more disciplined than they have ever been. Certainly on the corporate side, you could say, I go back into the 80s and 90s, Canadian bank lending. Canadian banks were very big into third world, the emerging markets in South America in the late 1970s and 80s. They took huge bets, billion-dollar exposures. And the banks were tiny then compared to what they are now. Or the real estate market in 1993. 1993 was the commercial real estate meltdown when almost every major developer went bankrupt in Canada. The banks had big exposures to O&Y and Cadillac Fairview and all those developers. Those exposures would never be permitted, not anything close to it now. So I think the loan books, the corporate loan books are in excellent shape. The residential exposure, a lot of the residential mortgage are government guaranteed, of course, but there's still obviously quite a sizable balance. But there's been so much talk about potential trouble in the mortgage market. I think the banks are not only conservatively capitalized, but I think they have been monitoring this very, very closely. I think it's reflected, it has exerted some downward pressure on bank stock multiples, probably. But I think the banks are so strong, they can weather quite a significant downturn. There is nothing life-threatening out there like there was, I think, in the early 80s or in the early 90s. Nothing close to it.